This situation in this country is very tenuous, and that lends itself to like, what do I look for when I want to buy gold? I want to see falling nominal and real interest rates. And I think the next move is disinflation and then deflation. And that's when gold just performs spectacularly. So that's the next catalyst that I'm looking for. In a deep liquidity crisis, everything gets sold, and that includes gold. So that's not anywhere near the situation we have right now. The first move is a skyrocket. So when when the economic data deteriorates later this year, gold is going to take off to the moon, in my opinion.
Silver has a long history of being manipulated through booms and busts, owing to its status as a monetary metal, rendering it a strategic asset. Yet if gold and silver were to spike, it would potentially signal distress in the financial system and the dollar. Of course, the Federal Reserve and governments want to avoid this, so they have an incentive to manage the price lower. There are more gold reserves in the world than silver. Depending on the valuation, there are estimated to be more than $6 trillion in gold reserves. On the other hand, there are only about 1 billion ounces of physical silver reserves, which would currently have a valuation of only $16 billion. Because the market is so small, it's very easy to move the price. Despite recognizing its potential role in future banking system cycles, famous analyst Michael Pento currently holds no silver in his portfolio. With over 3 decades of experience in the industry, he sees frustration with silver, citing its susceptibility to manipulation and the challenges it presents to investors. He highlights concerning trends in the housing market, such as the elevated home price-to-income ratio, which exceeds levels observed during the peak of the 2006 housing bubble. This disparity, where home prices are 50% more expensive to own than to rent, underscores the fragility of the current economic situation. In response to these indicators, Michael has positioned himself in gold, citing its historical performance during falling nominal and real interest rates, which typically coincide with disinflation and deflation. As of this writing, the gold price has turned down and is trading at $2,027. The US dollar's rally weighed down the precious metal. The yellow metal dropped, even though the U.S. reported poor economic data. However, Michael anticipates a significant uptick in gold prices as economic data deteriorates throughout the year. Gold will soar in response to worsening economic conditions, propelled by factors such as a potential liquidity crisis. We will present clips from Michael Pento's interview with Commodity Culture. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Silver is a base metal and a precious metal, and unfortunately, it's probably the most manipulated and most frustrating market I've been in this business 33 years, Jesse. I find silver extremely frustrating to even try to invest in. So I have none of it right now. Again, silver might be one of the major holdings in the next reliquification of the banking system cycle that we're going to go through, maybe late in 24 and 25. But right now I hold about 7-8% of the portfolio in physical gold, and I'm very happy to be there. And the catalyst for that is just, we have this country's got such a situation of tenuous asset bubbles that are breaking, though it's being masked by the mainstream financial media. They don't talk about it much, but commercial mortgage-backed securities, commercial real estate properties are in a devastating condition. In fact, if you look at the home price to income ratio, it's higher today than it was even at the peak of 2006 in the previous lead up to the global financial crisis and the collapse of the housing market. It was 5 back then. Now it's 5.5. So we've never been in a worse situation, and home prices are today 50% more expensive to own a home, 50% more expensive than it is to rent. It's never been anywhere close to that. So this situation in this country is very tenuous, and that lends itself to like, what do I look for when I want to buy gold? I want to see falling nominal and real interest rates, and I think the next move is disinflation and then deflation, and that's when gold just performs spectacularly. So that's the next catalyst that I'm looking for. In a deep liquidity crisis, everything gets sold, and that includes gold. So that's not anywhere near the situation we have right now, the first move is a skyrocket. So when the Fed starts, so when the economic data deteriorates later this year, gold is going to take off to the moon, in my opinion. The only thing you have to look at, which will be on my radar, is if we get into a repo crisis, when the money markets get clogged. That would be an occasion for me to sell some of my gold. But it wouldn't be something I would sell for a very long time because I know what's going to happen on the other side of that.
High interest rates and the 4 commercial real estate markets are already weighing on the economy. When a short-term federal loan program expires on March 11th, these factors could exacerbate the challenges faced by regional banks. The Federal Reserve's decision not to extend the Bank Term Funding Program adds to these concerns. Established in March 2023 following the Silicon Valley Bank crisis, this program provided a short-term liquidity option for banks. Michael expresses deep concern about the repercussions of the program's termination. Michael anticipates a challenging scenario for banks as they face reclaiming their assets at current market values, which may lead to a decline in their financial soundness. This, coupled with the tightening of lending standards and heightened regulatory capital requirements, suggests a bleak outlook for the banking sector's stability. Moreover, Michael underscores the impending reduction in the reverse repo facility as another obstacle. This reduction implies a diminishing pool of excess liquidity accessible to banks. It is poised to exert substantial pressure on the banking system when coupled with implementing quantitative tightening measures. Michael notes that the rapid pace of quantitative tightening will reach $90 to $95 billion monthly. Such a pace could significantly strain banks' liquidity positions, further complicating the economic landscape. Let's get back to the interview.
I look at the second derivative of growth and inflation when I make my determination as to where I want to invest. And I also look at the liquidity impulse and the changes in those dynamics. So come March 11th, the Bank Term Funding Program is going to expire. I mean, I can't believe this is actually going to happen, Jesse. But this was the program that bailed out the entire U.S. financial system on March of 2023. Remember, we had these 4 banks go under back then. And the banks had assets that were really a problem. They were mostly treasuries and mortgage-related debt, mortgage-backed securities, CMBS. And they handed them off to the Fed at full value. And even though they were like 60, 70 cents on the dollar, and the Fed gave them Fed credit, 100 cents on the dollar, and told them to go out and make loans and buy more bonds and whatever. And that kind of floated the whole banking system up for the greater portion of like a year and a half. Once the bank has to take back their assets at the current value, market value, and then hand the Fed 100 cents on the dollar with interest, hundreds of billions, there's over $100 billion has to happen. These banks aren't better off now than they were on March 11th of 2023. They're worse. That's a big negative liquidity impulse. Now, in addition, here's another negative impulse that's ongoing. Banks are tightening lending standards. Now, the regulators are raising capital requirements while their assets are eroding even further. So that's 2 negative impulses coming March and in April. Around that time, around the end of March, sort of sometime in April, it's just a guess on the trajectory, the vector of the decline in the reverse repo facility, that goes to 0 or thereabouts in that time frame. Now, the reverse repo facility is the bank's excess liquidity that they were parking at the Fed out of the whole U.S. financial system, just laying fallow at the Fed, earning interest. And reserves are part of the high-powered money. It's part of the monetary base. It's Fed credit plus physical coins and currency. That's the building blocks of all money supply. It's just laying there fallow at the Fed. That's coming out. It's been coming out from $2.5 trillion to about $500 million now, coming out and flooding the market with liquidity, bond market, stock market, everything. Well, that runs dry the end of March, early April. And it's at that time, here's the 4th negative liquidity impulse. It's at that time that quantitative tightening will really begin to bite. And we know our lessons of quantitative tightening. This will be the fastest pace of quantitative tightening, 90 billion, 95 billion per month. That's what it's supposed to be. That's really going to put a lot of pressure on the banking system. So that's when I think this whole liquidity impulse that was turned from extremely negative positive to a positive in March of last year abruptly shuts off. So that's what I'm looking at.
Recent price movements further support the expectation of a positive trajectory for gold. Weekly price action suggests an imminent upward resolution to the prevailing triangle pattern. Confirmation of this trend shift was evident in last week's closing price, which surpassed the prior week's high, and the close occurred within the top third of the week's range. These technical indicators signify a bullish sentiment emerging in the long term, as depicted by the weekly chart, suggesting a favorable outlook for gold in the foreseeable future. We would love your thoughts on Michael's predictions in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.